I'm Sarah Borkson-Keto with NAREITsREIT.com. I'm here in New York City for REITweek 2015, NAREIT's Investor Forum. I'm joined by Jeff Horowitz, Head of Global Real Estate, Gaming and Lodging at Bank of America Merrill Lynch. Welcome, Jeff.
How are you today?
So in 2015, we've seen a continued inflow of foreign capital into US markets. Do you expect that trend to continue?
Yeah, I think that's a trend that we've seen on and off for many decades. You know, there are moments where it was the Japanese, Canadians, Chinese, etc. But the fundamentals are always the same. The U.S. is a liquid market. It's a very high-quality institutional market. It's viewed as a stable market, and a lot of people like the dollar. So if you look over the last handful of years, you'll see, last year was almost $50 billion of capital that came into the U.S. 2011, for perspective, was about half of that. And this year, over 40-plus year to date. The trends have always been the same so far in terms of where that capital has gone. So it's been a little bit influenced by the office sector. It's been markets such as Manhattan, Los Angeles, San Francisco, what we call the gateway markets. And the trend I think you'll see change over the next few years is I think you'll see more market spread. And so I think that just given the quality of the assets we have in various markets, the quality of the marketplace we work in and live in, I think you'll see more of the money move to different marketplaces, whether it's Texas, et cetera.
And how would you describe the level of property valuations and the implications for deal making?
So today you see cap rates at almost record lows or valuations almost at level highs. And the big difference though, if we factor today versus 2007, would be that we have very different interest rates. So we have a greater spread today, and many people will say room to grow. That being said, today the REITs are trading below net asset value in most property types. I think that this disconnect between public and private values has a lot of companies frustrated. I think as you walk around the conference the last few days, speak to different companies, you'll see that their operations are in great shape. And really the answer, I think, is just general market anxiety. There's a view that rates will go up and the stocks are interest rate sensitive. So that's caused some frustration. I think it's led to many companies having a hard time competing on single assets versus private players or institutions. But I do think it has a great outlook for corporate deal making as well on a larger scale.
And do you feel that conditions are in place for increased privatization of real estate assets?
I do. I think if you sit in my chair, we've had more conversations with boards about strategic alternatives in the last 6 to 12 months than the prior 4 years. There's been really no other time like this since 2006 or 7. And many of the charts we use are even the same. We have conversations about cyclical pricing versus secular pricing. We have conversations that the gap between pricing in the public markets and the private markets has spread a little bit. It's been a little higher in the private markets. So there's a good backdrop for it. The part that makes it a little bit tough, though, is that the companies are pretty large. And so an average company today is much larger than it was a handful of years ago. And where in 2006 and 7, many of the large buyers were opportunistic players, the returns today, given where pricing is, aren't necessarily opportunistic returns. So we need core and core plus money, which is a little bit cheaper, but also a little bit slower. And so that's made it a little bit hard to get some of these deals really effectuated. But I think there'll be more to come.
All right, thanks very much, Jeff.
Thank you very much.
And for more news and analysis on all things REIT, be sure to visit REIT.com.